Corporate finance practice problem using Excel. Preferred dividends in arrears calculation. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information on the left-hand side, we're going to populate that into the blue area on the right side, looking at preferred stock dividends in arrears. Remember that when you're thinking about preferred stock as opposed to the common stock, one of the benefits about being the preferred stockholder, one of the reasons it would be indeed preferred, is that you can possibly get the payment of the dividends first, having to clear or pay off the preferred dividends before you can pay off the common stockholders. This can be a pro or a con because the preferred stockholders in that case are more likely to get paid, but if the income goes well and the amount of dividends that are being distributed out are higher, then the common stockholder has higher potential for higher earnings as income goes up, whereas the preferred stockholder, you could think about generally being capped at the dividends that would be agreed to. Now, typically the corporation will be able then to not give out dividends. So if they just decide we're not going to give out dividends, then they don't have to pay it out usually to the preferred stockholders, but you end up with this dividends in arrears that you're going to have to pay out. That's going to be the accumulation of the dividends before you can pay any dividends to the common stockholders. So this will be an idea, just a reminder of that type of situation. So we're going to assume the annual dividends per share for the preferred stock is going to be $9. So they have to pay basically that $9 per share. That's what basically the agreement is for the preferred stockholders. Notice on the common stock side, there is no set agreement that's actually set in stone in terms of what the dividend will be. There's more flexibility for the corporation to decide how much they want to get to the common stockholders. So if income is low, they can decide to simply pay the preferred stockholders or possibly not pay anybody, not anything going out to the common stock or preferred stockholders, but they can't basically pay the common stockholders and not pay the preferred stockholders. So we're going to say the annual dividends per share, the $9, has not yet paid dividends for 5 years. So we haven't paid dividends for 5 years. So we have the dividends in arrears then. So the preferred stock outstanding, we're going to say are the $300,000. The common stock outstanding, we're going to say are the $600,000. And the next year, earnings after taxes was, we're going to say $10 million. Earnings paid to preferred stockholders. So then they're going to try to pay off the dividends. So where do we stand in terms of what are the dividends in arrears after the 5 years, which we would have to then pay off before we could start giving dividends to the common stockholders if this was indeed the case. Let's think about the annual dividends per share. So we'd say annual dividends per share are going to be $9. That's what the agreement is, that they need to be paying out per year. And if they're not paid out, if something less than that is paid out, that's what's going to result in the accumulation of these dividends in arrears. So the preferred stock outstanding, how many shares are out there? So that's going to be 300,000 shares. Therefore, underlining that, we're going to say that the dividends per year that need to be paid off to the preferred stockholder are going to be 9 times the 300,000, 2,700,000. That has to be paid to them, or if it's not paid to them, then nothing can go to the common stockholders. So they have to clear that threshold before they can pay off the common stockholders on a yearly basis. And if they don't, they could decide not to pay any dividends at all, nothing going to common or preferred stock. But in that event, they'd have to pay then it'll accumulate upwards and they'll have to pay it at a future time. So we've had that accumulation, which we call dividends in arrears, of font group and underline. Preferred dividends in arrears then is going to be the 2,700,000 per year times the 5 years. That means they owe $13,500 before they can pay anything to the common stockholders. They basically have to pay those off. Notice if things went well, then, and if they had more money and they were paying higher levels of dividends and they cleared the dividends and arrears and the 2,700,000, they would not have to pay more than the $9 per share to the preferred shareholders. Whereas on the common stock side, if things are going quite well, then they can decide to pay more of the dividends out to the common stockholders and or put them back into the company, which you would think then would grow the value on the equity side, possibly more so for the common stockholders. So then let's go back down and say, well, now let's assume another year has passed, and now they have these earnings, the 10 million in earnings, which they're going to pay off and try to pay off the dividends in arrears with the earnings for that particular year. So we're going to say, all right, let's do this calculation again. Same calculation. The annual dividends per share are $9. The preferred stock outstanding is still 300,000. Underlining that, font group and underline. That's going to give us the preferred dividends per year, which is going to be equal to 9 times the 300,000. And now the years that have not yet been paid include the current year, which is now the 5 plus 1 or 6 years at this point in time. Font group and underline, that's going to give the preferred dividends in arrears, including the current year of the 27 times the 6. That's the 16.2. Now, they're going to pay off what they can with the earnings that they had in the current year. So we got the preferred dividends in arrears, 16.2, and they're going to be paying off with the earnings of the 10 million. 10 million being paid off. That means they still have dividends in arrears of the 16.2 minus the 10, or the 6 million twos, font group and underline. So they'd still have to pay off then the 6 million two before they can continue paying on to the common stockholders. This concept kind of emphasizes the fact that if you think about the dividend, the preferred stock versus the common stock, you're typically thinking about a situation where they have that more security. They're going to get paid first, in a similar way of the bonds being more secured. If there's some kind of bankruptcy or something, then the bonds would typically be more secured if they had collateral security in some way on it than the common stockholders. But again, the downside, of course, being that in good times, you're going to be capped out at what you've agreed to be paid. Whereas hopefully on the common stock side, if things on good times go well, the value of the common stock can go up, and possibly having dividends that will go up in relation to it, as well as the value of the stock that is being held.